morning, everybody. Thank you very much for coming. I'll be brief because I'm not the person you've come here to listen to. But I just want to say a few opening remarks about risk and the importance of it. The most basic responsibility of trustees is the interests of members and beneficiaries. Now, for defined benefit schemes, obviously, that interest is delivered by providing the benefits promised under the rules of the scheme. For defined contribution schemes, the interest is not so clearly defined, it's not so specific, but it is still the central responsibility of trustees. And when we talk about risk, what we mean is very simply anything that threatens the interests of members and beneficiaries. And therefore, risk is anything that might prevent trustees from doing their job. So therefore, risk awareness, risk management should be at the centre, should be at the forefront of trustees' minds in everything they do. And that's essentially why we're here this morning, to talk about that. So IORP 2 has obviously brought a lot more formality to the place of risk in the work that trustees do. For some trustees, this has meant a lot of change. For other trustees, it's less true. Some trustees have been risk aware already, but even for those trustees, what IORP 2 has meant is a lot more formality, a lot more process, a lot more reporting. So, and I suppose an important aspect of IORP 2 also is the requirement to have a risk key function holder, which brings a professional aspect, professional support to risk management, and this is a very, very welcome and important part of IORP 2. But all of these involve change, and our objective this morning here is quite simply to support and to speed that change. And what we don't want to do is to invent from scratch lessons or approaches to risk that have already been developed elsewhere. There's an awful lot we can learn from other financial institutions, from what has happened in other countries and other jurisdictions. And that's from three of our speakers. They will share what they have learned and what we can learn from them here this morning. And then Grace will set out what's very important, the Pension Authority's expectations of trustees and of risk key function holders in the coming months and years. So I'll shortly introduce the first of our speakers. As Grace said, there will be the opportunity for questions after each speaker. There'll also be some opportunity at the end of the conference for more questions, that may be more general questions or questions that may apply to more than one speaker. So our first speaker is Tim O'Hanrahan, who is the head of supervision, the insurance supervision division in the central bank. And Tim has worked in central bank for over 20 years, primarily in insurance supervision, but also in banking, internal audit, and as senior advisor to the deputy governor for prudential regulation. He's not just an insurance person, though. He's the current central bank nominee on the Pensions Council. Tim is a chartered accountant and a CFA charter holder. So Tim, over to you.
Thanks, Brendan. So good morning, everybody, and I'd like to thank the Pensions Authority for inviting me here today. And as Brendan said, my name is Tim O'Hanrahan, and I am the head of insurance supervision in the Central Bank of Ireland. So our main objective in the central bank is the adequate protection of policyholders, and risk management is a key part of our toolkit. So when Grace asked me to speak, I was delighted to share my insights from risk management in broader financial services to you in the pensions industry as you implement these new standards of risk management. You are implementing standards that apply elsewhere. So what I will give you today is a broad overview of those standards that apply elsewhere, observations on looking in at the pensions industry, and then lessons learned from the insurance industry, who implemented Solvency II, which is very similar to IORPS, a number of years ago, specifically in the areas of the board, the risk management function, and this enterprise risk management approach called the ORSA. And this should help you as you introduce these new requirements and manage the risks both to the beneficiaries and also to you as trustees. So, looking at the first slide, what is happening to you has happened to everybody else. The banking industry, the insurance industry, and investment firms all have these requirements in place. Quite simply, they're requirements, governance requirements for boards, requirements for the risk management function, and this enterprise risk management approach, which in insurance is called the ORSA, and you have a similar name. You don't have regulatory capital requirements. The regulator can't impose capital requirements from doing a risk assessment, so that's a difference. So the advantage to you is you can learn from other industries as to what worked for them and what didn't work for them and see what you can take from that. Before telling you exactly about risk management and saying all the wonderful things about it, it's important to take a step back and ask, all those industries have implemented risk management, so has it made a difference? And I think the answer is a little bit nuanced. If you look at what the financial system has just come through, we've had a global pandemic, there's been a massive change in the interest rate policy, there's significant geopolitical risks, and as a whole, the financial services industry has held up robustly to date. There's still significant risks. There's a massive amount of government debt, and central bank balance sheets have increased since the pandemic, and we haven't decreased those in history before, so who knows what will happen when that happens. We have higher interest rates for longer now. What does that mean as it works its way through the system? But overall, the financial system to date has held up well. However, there has been notable exceptions, and looking at some of those exceptions can be instructive to you as you implement risk management. The first case, just SVB Bank. So in the US, there was a report to the Board of Governors of the US Federal Reserve, and they said with SVB Bank, it was a textbook case of mismanagement. The board didn't hold management to account. The management failed to manage basic interest rate risk and liquidity risk, and Federal Reserve supervisors didn't take enough action. So basic failures in risk management contributed to SVB's failure. If we look at Credit Suisse, one of the oldest banks in the world, earlier this year it was taken over. The Swiss regulator, now it has the benefit of hindsight, and we're all much better with the benefit of hindsight. The Swiss regulator looked into one transaction and with the Archegos hedge fund, where Credit Suisse lost $5 billion. The Swiss regulator said Credit Suisse took too big a position and too many risks. There was no oversight of the executive board. There was insufficient response to overruns and concentrated risk. So again, more failures in risk management. If we look then at a more subtle case, LDI in the UK, and the Bank of England, they wrote to the Treasury Select Committee, and they found that the move in gilt yields after the UK budget introduced by Liz Truss's government, it created significant upheaval in the markets. So this exceeded these, so the buffers weren't sufficient in these leveraged LDI funds, which required them to sell gilts into a falling market or get more funds from their sponsors. So the pensions regulator looked in afterwards and said there was a need for stronger governance, stronger operational processes, and more oversight. But they also said the trustees must understand the risks if they're involved in leveraged LDI investment strategies, and they required them to increase the buffers they hold. So again, in this case it's different. More sophisticated risk management is needed. So what I would say is when one looks at this, there's a strong correlation between firms who have good risk management and firms who survive and avoid pitfalls. And that's really important for you as trustees. You don't want to be the firm on the wrong side of this equation as trustees, and also for your beneficiaries. You want to protect your beneficiaries through your risk management. So the next area I want to talk about is when I look into the pensions industry, I was really interested in preparing for today's talk, but two things stand out. The first thing is the net worth of pension funds, and the second thing is the size and the number of pension funds. So on the slide here, it relates to the movement in the net worth of pension funds. So you can see the total liabilities of Irish pension funds, and these are statistics produced by the central bank, produced quarterly. And for those who can't see, they total around 120 billion, the total liabilities, and they're split between defined benefit and defined contribution. One item that stands out, and we'll circulate the slides afterwards, is the net deficit and net asset position. It moved from a deficit of minus 12 billion in 2020 to a surplus of 10 billion in Q3 of last year. So there's a massive movement in the net asset position of pension funds when you look in collectively. So the big question to you in this room is, as you introduce risk management, can risk management support you in better managing this risk for your pension funds? The second item that stands out is the number and the size of Irish pension funds. According to the Pensions Authority's last annual report, there's over 85,000 pension funds. The largest pension funds report quarterly to the central bank. So 450 of the pension funds have the vast majority of the assets, but even a smaller subset, 40, hold 50%. Less than 40 pension funds hold 50% of the assets, and less than 300 hold 80%. So you guys are experts in this, but there's a small number of larger pension funds who are very small by international standards. You've then a very large, maybe in the 10,000 cohort of quite small pension funds, and then you have thousands and thousands of one-member arrangements. So how is risk management going to support you in addressing these challenges? Because you need to manage complex risks in pension funds. Now, you are addressing this, and just on the slide in front, there's three things that stand out to me when I look at those key points. The first is structural change. And on the slide there on the right, for those who can't see it, you can see master trusts. And the balance in master trusts, these are DC pension funds moving in, has moved up to just under 14 billion at the end of Q2 this year. And that's moved up massively. So there's a massive movement in the pensions industry at the moment in relation to master trusts for defined contribution schemes. The next area is in bulk annuities. We're hearing in the UK there's significant movement. There's still an awful lot of small defined benefit pension schemes, a large number who've assets of less than 50 million. And when these risk management requirements come in place, what is the answer for these pension funds? I know there's no easy answers. There's questions as to legal covenants, there's questions as to surplus and deficit, but ultimately, does it make sense to manage such small pension funds independently? Those things still stand out. The next thing that stands out to me when I look in is, you're all going to need additional support to implement risk management, and I'll talk about that in a few minutes. But the big question is, where are you going to get it? When there's thousands of funds looking for that support, there's a limited number of professional services firms, there's a limited number of professionals, and we hear in the insurance industry that there's a massive war for talent. So you may have all these aspirations to get these people, to get these resources, to get consultants, but will the consultants be able to deliver what they say to you as trustees? Do they have the resources to do that? So how are you going to get the resources? There's also looking in at the industry, as I said before, other people have done this before. If you look at the banking industry or the insurance industry, just looking at the insurance industry, on the central bank's website, we publish the solvency and financial condition reports. And there's a 3 or 4 page summary of the risk structures they've put in place, what they do at the board, what they do at the board risk committee, and what the risk function does. So looking into the pensions industry, you can also learn from that. The next topic I want to talk about are lessons learned from the insurance industry. There's 3 areas I'm going to speak about. One is lessons for the board, then lessons for the risk management function, and then finally this ORSA approach. There's a number of things up on the screen there, and we'll circulate the slides later. There's 2 things that I want to touch on. First is embracing a risk culture, and second is upskilling and training. And what do I mean by that? To prepare for today, I read all of the ORSA reports of the insurers, the large insurers. And just to give you a flavour, you don't have to do this every year, I think it's every 3 years. But what they do is, they discuss it at their board 5 times a year. They discuss in the beginning the policy behind it, the assumptions they're going to make, the methodology, the plausibility of those assumptions. They then get back financial plans, they then feed this into medium-term capital plans, and then it feeds back into their strategy. So by the board doing this, they're spending a significant amount of time and they're signifying to the company how important it is for them. So companies who do this and embrace it, and boards embrace it, we see higher standards of performance. The second thing is upskilling and training. Boards, we've seen this before, boards, they look around, they say, what do we know? What don't we know? Do we need to get additional people with risk expertise? Do we need to train ourselves up? And where will we get that support? That's the other thing that successful boards do. They work out that they need to be open-minded to get additional training to support them to be the strongest board that they can be. The next area is the risk management function. Again, there's lots of requirements in place for risk management, but I just want to pull 2 points out. The first one is, where are you going to get the right resources? How are you going to get the right resources in the risk management function when there's a massive competition for resources? There will be consulting firms who say they can do this for you, but how much resources do you need to do this properly, and to ask yourselves that. But risk management has to be involved in the decision making. So to give you an example, so today, if someone wants to invest in new assets, normally the investment team would do a scan of the investment horizon, look at the strategic asset allocation, the tactical asset allocation, prepare a paper. But when risk is deeply involved, the risk function would also look at this transaction and the proposal. Both the risk function and the investment team would bring a proposal to the board risk subcommittee. The board risk subcommittee would then challenge them, ask them questions. The two teams would go away, feed that back, incorporate those responses into the proposals that they have, bring it back to the board risk subcommittee, who then brings it to the board for approval. So what you can see in that is the risk management function are deeply involved in the decision makings that the undertakings are doing, and it shows the importance of risk management function, which is really important to protect the insurance companies and also to protect your pension funds as you move forward. The final area I wanted to talk about are ORSAs, or own risk solvency assessments. And these are the new tools. Many of them, I think you have to produce them by April next year. So these are enterprise risk management approaches, which incorporates a lot of what many people do already in their day-to-day jobs managing pension funds. But what I see, where you see it really come to life, is where people change and they don't see this as a burden. They see this as a tool to help them manage their risks. It is an awful lot of work. It's an awful lot of work the first time. It's probably expensive. But if you begin to use this as a tool, and where you see it come to life is when companies begin to do stress and scenario testing, both quantitative and qualitative. Now, it applies in different ways to define benefit and define contribution schemes, but what you see is you might have all the financial variables, and they're all stressed up and they're all stressed down, and then what happens to your pension fund? But what's also really important is the qualitative stuff. What we're seeing today is, when I was reading through the ORSAs, there's stuff like staff turnover, access to distribution models, but also the central bank is asking the firms to look at climate risk, sustainability risk, operational risk. So they put all of these things into their ORSAs and then they think through them. What brings it together is when they do scenario analysis. So people then pull all the different variables together and they do a scenario analysis. They give input into that scenario analysis, and then they say, what's going to happen to our pension fund in this scenario? For example, if there was a change in government, a change in tax relief on pensions, interest rates remain high, the Pensions Authority requires you to do a climate change scenario, what's going to happen to your fund in those circumstances? So what you get from this ORSA is a really good document that you've inputted into, which moves all the variables up and down, puts all the latest things you need to think about into a document and says, well, what's going to happen to our pension fund in this regard? So this is going to bring me to the end of my talk today. What I'd like you to take away from today is, the first point is, what is happening to you in the pensions industry has happened elsewhere, and you can learn from what has happened elsewhere. Risk management is not a panacea for all your problems, but using risk management as a tool can make you avoid the pitfalls that happen to companies and to pension funds. When you look in at your sector, two things stand out: the large movement in the deficit and surplus of the defined benefit pension schemes and how you can use risk management to better manage that, and how are you continually going to move along the journey to work out the most efficient structures for pensions in Ireland. So looking at the insurance industry then, the board getting deeply involved, getting the right resources in the risk management function, and embracing the enterprise risk management approach can help you better serve your members, but also protect you as beneficiaries. So I'd like to conclude by saying it's a really exciting and interesting time in pensions, and the actions that the people in this room take will improve the pensions of future pensioners in Ireland, and I wish you the very best of luck as you implement the risk management requirements. Thank you.
Tim, thank you very much for that. A lot of food for thought. I should have said at the beginning that this conference this morning is being recorded because there were so many people who we couldn't accommodate. So we will be recording all of it, including the Q&A. So it's just no harm that you be aware of that. So we have the opportunity now for some questions. So just put your hand up when we get a mic to you. However, the privilege of chairing the conference is that my questions come first. Tim, what was the biggest challenge in Solvency II, in ORSA, in kind of bringing the insurance sector up to speed?
I think today is just a perfect example. When we had Solvency II, the insurance industry really wanted to engage with the regulator, so there was a lot of positivity and enthusiasm to implement it. But I think the biggest challenge was there's so many parts of regulation nowadays, it's very hard to do. So what are the key important things where you get value out of it? How can there's thousands of pages of regulation, and anyone who has to endure it in compliance departments, there's level 1, level 2, level 3, but what's the really good, important stuff that can help us run our business? And that's where people who, they had to work through all of the paper, all of the stuff, but that's where you saw it really add value. And people who got through the pain and then saw, how can this add value to your business? And what you've seen is with some insurance companies is that some of them have big challenges with their business models, because what's the future for the savings business? Is it in large life assurance companies in Ireland? But some of them have they've twigged this and they know what's going on. They're looking at the different dynamics and they're diversifying themselves. So what I would say is the biggest challenge is getting through the volume of stuff. But then the benefit is seeing what can this do for each firm and how can we get value out of it, because it is a requirement. You have to do it. It's European stuff. We're implementing it. There is nuances how we implement it, but just getting through it and then getting it to add value, Brendan, I'd say would be is the best solution.
Thanks, Tim. One of the things we, the Pensions Authority, are doing is we're saying to trustees, you must think about risk, you must talk about risk, you must carry out your own risk assessment. And I suppose what's in my mind is, if it hasn't happened already, next Monday the trustees are going to meet, trustees of the pension scheme are going to meet, and item 1 in the agenda is going to be risk. And everybody's going to look at each other and say, okay, risk. How do the people in this room, how do they structure that conversation?
I think it's really positive. The first thing is you put it on the agenda and you begin to discuss it. Then you get your suite of risk reports, and you go through the risk reports and you see what they're saying. Then you begin to sit down and just with the ORSA process we spoke about, the ORSA process, the enterprise risk management process, you start off, you sit there at the board, you get your consultant in or the risk manager to do the work, you sit down, you say, what's going to happen? Here's the key assumptions. We've been around the block once or twice. You're the risk expert who knows to put the words we use into the things that the regulator needs or that are right to do, and you start. And then you schedule the next meeting and you put it in 5 or 6 board meetings and you get it done. And that's what you do. It's hard work, but the prize is, apart from you avoid the hassle of the regulator, you begin to see, look, here's what the future is for our pension fund. Here's how we best protect the beneficiaries into the future. And here's really good support to help us make those decisions. So I think if you take that approach, you start off, you do the basics, you meet about it, you get the risk experts to do the detail for you, you come back, you have a discussion, and then you see the output of this. And again, like we've had ORSAs now for 7 years. The first year people don't get it right, or not even right. The first year it's a process where the quality improves every year. And then we write out to firms, we might write an industry letter saying a bit more of this, a bit less of this. And then what you see is the regulators get whatever the latest trend is. They tell you this year we want you to do ESG, we want you to do operational risk, we want you to do cyber risk. So while it is your own risk assessment, you're given suggestions about what should be included in the qualitative assessment. And what you see is pretty good quality documents appearing over time. When I was reading them, like they're pretty substantial documents. They're over 100 pages, and that's summarizing an awful lot of work that's been done during the year.
Okay. First here.
My name is Cleena Judge. I work with the UK Pensions Regulator. Tim, thank you very much for that. Very enlightening, definitely things I can take away. My question is in relation to ORSA and assurance that it gives pension schemes. Definitely nobody wants to be on the wrong side of any new risk that emerges. What's ORSA's role in identifying emerging risks, so things that people don't know about yet, and what assistance can it give them that maybe they won't, but at least they're in best place to identify those risks and put in place the tools to deal with them?
I think if I knew the answer to that question, I wouldn't be sitting up here. But how can you deal with emerging risk? What you do is you look at you get economic forecasts, you get consultants to tell you what the potential things in the future are. You sit down yourselves and you think, well, here's our pension fund, here are potential future things that could happen. You work out the probabilities, you then begin to design scenarios and you put it all together. And once you sit down and you do it, you end up with lots of things. Now, are you going to spot many things? Like we had the COVID pandemic and nobody spotted that. But by doing all of this and by working your way through this, you're in a better position for things that happen. So even if you don't spot the thing that's coming, you're in a better position. But even when one looks now, interest rates are much higher and the mood music is they're going to be higher for much longer, and that hasn't really followed through yet in the economics and what that's going to mean into the future. From the pandemic, central bank balance sheets have never been higher. We've never been through a period where we've deleveraged to such an extent in history. You need to go back hundreds of years. No one knows what's going to happen when those things happen, when you pull so much money out of the system that we've all become addicted to. If you look to Ireland in the future, if you look at the budget and yesterday and they're putting money aside for the future, what happens if those things were ever to change? So they're big questions that you guys debating them and putting them into your own assessments would result in, you might not have the perfect answer, but you'll probably be better prepared than if you hadn't done it.
Good morning, my name is Kate Brady. I'm here in the capacity as a trustee. The organisation I'm with happens to be a financial services organisation, so we have experience of working with the CBI as our regulator. And I'm interested to know, Tim, a lot of your advice today was for the players in the pension industry that are sitting looking at you. But what has been your advice to the Pensions Authority as the regulator entering into this period? It'd just be interesting to understand what the advice is, Sue, to your fellow supervisors in terms of their approach, hands-on, how involved to be or not to be, etc. Thank you.
That's a good question.
But I think the Pensions Authority are in a similar position to many regulators. They've got this, I suppose, pensions industry which they have to regulate. The rules and the laws are changing, they're updating. And probably where most regulators operate today is a risk-based approach, looking at where the biggest risks in the sector are, allocating sort of resources in that space, and then trying to solve those things as quickly as possible to end up in a stronger position for Irish pensions in the context of sort of limited resources. So I think that's what most regulators do, and I think that's what the Pensions Authority will be doing as well, looking at here's the resources they have, here's the risks they face, how can they best apply those things, and as they begin to look to the longer term. But even today, without spending a massive amount of time, when you see the deficit, surplus and defined benefit, what is the answer to that is a question, and I think some speakers from the UK government are having consultations at the moment, and it seems that the guidance from the pensions regulator in the UK is different to what the government is intending. They're really big questions, and they're perhaps, I think sometimes those questions are almost, they're really important as to how the market functions and operates. So engaging on that level is also important. And then also the size and the structure of Irish pensions, keeping the focus up on that, getting people in this room to say, like, what is the answer to, the answer to one-member arrangements, you can come up with an answer. What's the right size for a pension fund? And for industry and the regulator to engage in that. So in 5 and 10 years' time, Ireland has the right structure of pension funds to meet the needs of pensioners. So I think they would be the type of things that I mentioned when I looked in that are important. But I would just encourage the Pensions Authority to, I suppose, to continue on with the work that they're doing and work with the industry and also get the resources that they need so they can implement things.
Thanks, Tim. I'm going to move on now, but there will be the opportunity to ask Tim further questions at the end. Our next speaker is Alan Pickering, who's a name that may be familiar to many of you. Alan has spent most of his career at the interface of public policy, financial services and employee benefits. He's worked in both Britain and Europe, and he's currently a full-time professional trustee. In 2002, Alan produced a report for the UK government, A Simpler Way to Better Pensions, which gave rise to risk-based and proportional regulation in the UK. So Alan is obviously very well placed to give us his views and to talk about the balance between risk management and consumer outcomes. Alan, very glad you could join us.
Thank you. People who know me might wonder how it is that the Pensions Authority, having a conference on risk, takes the risk of inviting me to speak. Some might say it's downright reckless, but I'll do my best to prove my friends wrong and honour the invitation that I've so kindly received. Just to get us into the right frame of mind, let's look outside the world of pensions. And recently in Britain, it came to light that a number of hospitals had ceilings and roofs that had passed their sell-by date to such a point that they were in danger of falling in. The cry was, shut down the hospitals. And then I thought, why? Because if you shut down the hospitals, people will definitely die because they can't go to hospital. If we have a proper risk assessment and risk mitigation program for the hospitals, we can't guarantee that nobody will be hurt, but overall the outcome for society would be much better in keeping the hospitals open rather than closing them, just in case someone got hurt, just in case a roof collapsed. Paradoxically, it might have been a lot easier for the hospital managers if they could close the hospital down, because they wouldn't have to stand up on a public platform and explain the relative merits of one course of action versus another. And on a risk-aware basis, they decided that more public good would be done from keeping the hospitals open rather than closing them. And I think that's a useful approach for trustees to adopt, because life isn't risk-free. It's all about identifying risks, avoiding those that can be avoided, but not avoiding them at all cost, if the cost is worth than living with the risk. What I would like to do is just to raise with you 7 high-level areas of risk that will hopefully allow you to approach risk management with some enthusiasm, rather than foreboding, thinking, here we go again, another tick box exercise. What's the point of gathering all this data? Does it pass the so what test? So the 7 areas that I want to deal with are political risk, sufficiency risk, political risk, regulatory risk, the risk of employer disengagement, investment, admin, and governance. And just a couple of minutes on each of those. I had the privilege yesterday of listening to the 2 budget speeches made in the Dial. I think it was a privilege, but it kept referring to the future. But the 2 ministers who spoke, when they were talking about the future, said 2023, 2024, 2025. That's not future for you. Future for you is 2035, 2045, 2055. How long can we run a scheme that meets the needs of your clients, your customers, your members? I think we just have to accept that there is a failure of calibration between the political time frame and the time frame within which we operate. It's often difficult to get politicians to think about pensions, but you do get some who are hyperactive and want to achieve an awful lot. What they never think about is the implementation challenge of all their good ideas. An idea isn't good unless it can be successfully implemented in a timely fashion. I think in many ways my most disappointing political memory is that in Britain in 1997, when the Labour government came to power with such a big majority that it had at least 2 terms in office and eventually had 3 terms in office. And that would have given it time to really modernise the pension system at a time when it was doing okay but could do better, and folk knew that if nothing was done it would get worse. But they didn't really have the courage or the foresight to plan for those sunny uplands, even though there'd be some treacherous mountains to climb in terms of refocusing public priorities to reach those sunny uplands. Yesterday, obviously, the Labour government, or the incoming Labour government, possible incoming Labour government, was talking about 2 terms of office, and that almost sort of calibrates their timetable with our timetable. So let's see what an incoming government does in terms of future pension thinking. One of the problems with the pension system is that it needs to deliver sufficiency. And sufficiency really is the key, or lack of sufficiency, is the key risk that we face. There's no point having a pension system unless it allows people to enjoy retirement rather than simply endure old age. And in Britain, there has been a search for a market-related solution to providing a guarantee against absolute poverty in old age. I would argue that there isn't a market-related solution to absolute poverty in old age. The state, the taxpayer, are the only folk who can cost-effectively provide such a guarantee, such a foundation upon which market solutions can be built. In Britain, market solutions really were used to make up for shortcomings in the social security system, and that isn't a sensible way forward. The incoming Labour government in 1997, to which I referred, thought that something called stakeholder pensions, which were a sort of voluntary form of auto-enrolment, would make up for the shortcomings. It didn't. The next Conservative coalition government, Conservative Liberal government, actually went for wholehearted auto-enrolment. And unlike the Labour predecessor, there was no small scheme exemption. And I think that in an ideal world, there should be a small scheme exemption. The Labour government was criticised by the diplomatic community who weren't going to be in Britain for long and thought, why should we provide pensions for our nannies and our gardeners who aren't going to be in Britain for long either. So I think there are challenges in including the smallest of schemes in the auto-enrolment system. The coalition government did introduce auto-enrolment, but after it introduced auto-enrolment, it lifted the basic state pension to a level where in future it does provide a guarantee against absolute poverty in old age and gives politicians the right to redefine what's meant by old and what's meant by absolute. And again, your finance minister yesterday confirmed that whilst contributions might be going up towards state pensions, there was no intention at the moment to redefine what is meant by old as an age prerequisite for claiming that pension. And I think that had the basic state pension been lifted to that level before we got auto-enrolment, we might not have seen auto-enrolment extended to the smallest micro firm, because that, again, is where the real challenge is. And that challenge was referred to yesterday by some of the commentators who said that there might have been some goodies in the budget for small firms, but auto-enrolment was going to almost outweigh all those goodies. I don't want to get involved in your politics, but I do understand the angst which trying to incorporate small firms in a national pension system brings about. So the first risk is that the pension system doesn't deliver. And for the state pension system to be successful, we need a partnership between a state basic foundation and then a market-based solution to add on top of that. I mentioned the second risk already, that of a lack of political alignment, the political calendar alignment with your time scales. The other political risk is that politicians see these large amounts of money being accumulated and they say, well, this is really public money and we are the guardians of the public, so let us as politicians tell you what to do with the money. I would say, on your bike, it's not public money, it's the public's money, and the public has entrusted that money to provide later life financial security. Now, if it can do good things between now and then, so much the better. But really, one must acknowledge the primary purpose of a pension scheme is to provide later life security for workers and customers. Third risk is that of regulatory risk. And the chairman mentioned that in the report that I wrote for the British government, I advocated a regulator who was risk-based and proportionate. And that's the most difficult sort of regulator to be. Anybody can be a supine regulator. Anybody can be a regulator in hobnail boots. The real challenge is to be a risk-based and proportionate regulator. Just recently, the British regulator produced a paper on improving diversity, inclusion, and equality. And they are attributes that are close to my heart. But I don't believe in a top-down approach to diversity in inclusion, but a bottom-up approach where people can be as good as they want to be, or even as good as they can be. And everybody should be able to aspire to be a trustee or a regulator. To try and create diversity on a top-down basis could still result in all of the people in power having had politics, philosophy, and economics degrees at Oxford University. There might be different gender, different racial complexion, but not particularly diverse if they've all come from that same educational background. And somebody said to me, what should the regulator do? Should the regulator produce a checklist? I said, no, the regulator should win hearts and minds rather than tell people how to have diversity, inclusion, and equity. If you tell people, and you've really lost the argument, it just becomes another checklist, chore, compliance, chore. And there's a real danger that if regulators do become too prescriptive, then they lose the moral high ground if, for no fault of theirs, that prescription proves not to have longevity, and they lose the ability to independently help people come to terms with risks that nobody, even a good regulator, could have anticipated. When the UK regulator was established, its priorities were to educate, enable, and enforce. And I still think that that is a very powerful trilogy. There are people out there, and they might even be in this room, who will say to regulators, tell us what to do, and then they will get paid by their clients for simply passing on the message from the regulator. That's in nobody's long-term interest, because consultants who simply act as a transmission organ for regulatory outpourings will not be able to remain in business for very long. They'll be seen as the charlatans that they are. In terms of coming to terms with your challenges, you should decide what makes sense for you and then test that against the regulatory compliance framework. Don't start with that framework to narrow your horizons. You should think, what makes sense for me, my employer, my clients, my members, my customers, and then test for regulatory compliance at the end of that process, rather than use a regulatory checklist to narrow the areas that you might consider to produce a sensible solution. The next risk is that of employer disengagement. And although I'm involved with a couple of consolidation vehicles in the UK, a DC Master Trust and a DB consolidator providing a bridge to buyout, I still think that employer engagement is imperative. I would like pension arrangements to be seen as a valuable employee benefit rather than something that employers have to do because someone's told them they have to do it. I think we do need to maintain employer engagement, even if that engagement isn't having a single scheme for every individual employer. In the context of master trusts, it's possible to have employer engagement either on a one-to-one basis or through employer forums. So I think to do anything that risks employer disengagement will be a retrograde step. And to try and make it easy for employers to engage. I think we need to simplify the system as best we can. Again, one of the mantras that I articulated in the report that I wrote for British government was that a pension is a pension is a pension. And it doesn't matter whether it's a contract-based arrangement, a trust-based arrangement, DB or DC, they should all rank pari passu in terms of security and in terms of any tax incentives or regulatory requirements that might be imposed upon them. It's difficult enough for an employer to maintain engagement and to suit and to choose the type of arrangement that suits them best if those arrangements are subject to different regulatory or tax requirements. That, again, just runs the risk of employers saying, tell me what to do and I'll cough up with good grace. But I'm not really happy with what's going on, so we lose employer engagement at our peril. Next risk is investment, and I've already mentioned that there are people who think they know better than you do what to do with the investments. I don't think there is a single simple solution to the investment needs of every pension holder. Some people will regard volatility as a risk. Others would regard volatility as a means of pound cost averaging. And one has to have due regard to the end user, the employer, the customer, the scheme member to determine how volatile the investment strategy should be and what sort of output that investment strategy might be aimed at. And with scale, there are things that we can do that we can't do in the context of small schemes. Some small schemes are really well run, really well resourced, but there are things that it's very difficult for them to do cost effectively. And one of the things that large schemes can do is sort of segment the pensioner population in later life, determining whether on a cohort by cohort basis or individual by individual basis, you can decide how to spread your DC entitlement throughout your retirement. Do you give a high priority to going off to Barbados in your 60s or living in this hotel in your 90s? And it really is a case of trying to help members allocate their resources throughout their later life to meet their needs, or at least to assume that their needs reflect those of folk in similar cohorts, similar composition. Lots of time is spent on investment risk, but to me, the most important risk is administration. If we can't get administration right, if we send letters to people who died several months ago and caused distress to family members, what trust will people place in our ability to invest the money center? If you can't even write to me properly, why should I trust you with my savings? As we move into a DC world, administration becomes even more important. In DB land, you only had to get the sums right once every 40 years. In DC land, people have got hourly dealing opportunities, and if you mess up with those dealing opportunities, just try and put them right. It's an awful job to try and recreate what should have happened had you not made a mistake. A reference has already been made to how tight the labour market is for pension professionals. That applies particularly in the world of pension administration. And with scale, we shouldn't ignore individual needs. Somebody said to me, well, my scheme hasn't got any vulnerable members. I said, rubbish. Every scheme has vulnerable members. Their vulnerability may mean that in a digital world, there comes a time when they need to speak to a human being. I used to work for a firm of actuaries, and in the next room to me was one of the brightest people you could imagine. but he would often come to work in odd socks. And that wasn't because he was making a fashion statement, it's because he was sartorially illiterate. Now, if someone as bright as that can have shortcomings in their psychological ability to handle life, then we all have vulnerable members, and we need to think through how can we communicate with these members in a way that meets their needs. We mustn't just regard them as an amorphous block of 1,000 people. They are 1,000 individuals who we have to deal with as best we can. Move on to the final area, which is that of governance. I've mentioned already that I like the trust model. The trust model wasn't designed to meet the needs of pension schemes. It was designed in the Middle Ages when rich men, and sadly there were men because women weren't rich in those days, rich men went off to fight the good fight, and they found somebody and said, well, if I don't come back, this is a list of what I own, and this is what I want you to do with it if I don't come back. And many people say, surely that model can't be applied to multi-billion-pound pension schemes. It works, and even in the areas of consolidation to which I've already made reference, DB, DC consolidation, where the trust model works hand in hand with the contract arrangements, because those who set up master trusts, or DB consolidators, are there to make a profit in a way that employers who set up pension schemes weren't there to make a profit from their pension scheme. They wanted it to add value. But I think the trust has stood the test of time, and it is possible of evolution to meet society's changing values, changing priorities. The budget speeches yesterday went on too long, and I want to avoid the risk of going on even longer than I have already, because no doubt you're saying, when is he going to shut up? And me talking to you may well have run the risk of challenging your sanity, and if that is the case, then I apologize. But because of Brexit, it's lovely for me to come here, but I have to go home. Can't stay too long. I'm going home on the 3:45 flight this afternoon, and before I'm allowed to get on that plane, the pilot will have looked at her procedures, her checklist. It's a diverse, inclusive airline, this one. That she would have looked at her checklist, looked at her risk register, and hopefully it's a relatively focused risk register, because a film star yesterday got criticised for using her Oscar as a doorstop. Some risk registers are so big that they would even outdo that Oscar as a doorstop. They either give you a hernia or they are the biggest risk that you run. But she'll have had a good risk register. She'll go down, walk round the plane, she will look at the plane, hands behind her back, and she'll think. And the only checklist worth the paper it's written on is the one where the bottom row says, now engage brain. I know that sport is looming large in your priorities at the moment, so can I express the hope that on Saturday both Mr. Farrell Sr. and Mr. Farrell Jr. are on the winning sides. And in obeisance to ESG, can I say that although governance is probably the most important of those letters, S is most important to me because it means social, it means helping workers repurpose. But today, let's focus in on the E and say, come on the green team. Thank you very much.
Has anybody got some questions? Just here.
Thank you. Patrick Cosgrave from an insurance company. Very interesting speech, Mr. Pickering, and thank you very much for your insights. One risk you didn't call out, which I think is particularly pertinent for Irish DC schemes, is I'll call benefit crystallisation risk. It's that cliff edge where the Pensions Authority has done all its regulation up to the point of where you're just about to retire and you've got your maximum funds built up or what have you, and then suddenly you're out of the trustee world and you're into the central bank world, where you're into individual product advice by and large. We've privilege of having both regulators in the room here, so I wonder if there's any words of wisdom you could provide to them and how all that can get joined up in an ORSA, because the one thing a DC scheme doesn't do today is provide a pension, income in retirement. It provides a savings pot that is then taken elsewhere to provide that income in retirement. So
yes,
any lessons around joining up that
there is, again, sort of a misalignment of regulatory impact here, because during the accumulation phase in the UK, we have lots of regulations in terms of cost versus value and charge caps. And yet when the person gets to the point where they want to crystallise their pot, they move into a world where there isn't the same level of control on cost. So the trustee world meets all the costs while the scheme is growing, and then when the members' pot gets big, some what they call wealth manager comes along and says, "Give that to me, I'll look after that for you." And I think that one of the advantages of having master trusts in the UK is that you don't have that false crystallisation. It might have made sense in the DB world, when at the age of 18, you knew when you were going to retire. But now in DC world, you don't know, and it may well be in later life, you mix and match work and retirement, pay and pension. And I think one of the advantages of master trusts is that we can take people through the accumulation, the consolidation phase, to which you need a consolidation phase, and then the decumulation phase. And I think that having that continual support from a commercial product which is overseen by trustees can provide the level playing regulatory field that you're looking for. So we don't force people to jump ship at that crystallization point. They will be able to talk to and indeed master trusts can have other things added to them. The master trust can be I'm not selling master trust, honestly, but the master trust can be the spine, and to that spine you can add limbs of financial wellness, mental wellness, access to all sorts of other things that will help us get more out of life and help us be more active employees and active citizens. And I think to provide that apprenticeship to grave transition within one financial institution has lots of attractions.
Thanks, Alan. Next question. Can I ask you a question, Alan, about master trusts? I'd be interested in your views on the potential conflicts of interest that can arise from master trusts, insofar as most master trusts have a for-profit backer. And, reconciling, I suppose, the priorities and the objectives of the financial backer of master trusts with the responsibilities of trustees. Do you see a tension there? Do you see a conflict, or what are your views on that?
Yeah, there is a tension, but I'm not sure that tension needs to lead to a conflict. I mean, the master trust that I've been chairman of since inception started off with no members, no money, and not necessarily adequate resources, although the regulator insists that there are adequate financial backings and other backings. But as that scheme grew, it was my responsibility as trustee chairman to make sure that the for-profit entity that was sponsoring it adequately resourced it and didn't have a sales force that would say yes to everything just in order to close the deal, because we've all lived through the insurance world in the past where people did say yes to everything and then created so much bespoking that the operation became unwieldy and in many cases died a premature death. So and it's not a perfect fit, but it's my responsibility, the trustee's responsibility, to make sure that the provider, the entity, and the labourer is worthy of his hire, and the financial services businesses are worthy of a return. But it's my job to make sure, as a trustee, that the members aren't taken to the cleaners by an irresponsible, profit-hungry business which wants to pillory the master trust. And there are, again, regulatory checks and balances. I have to pass a fit and proper person test, and I have to give regular reports, both in the context of my DB consolidator and my DC consolidator, saying what the trustees have done to make a difference. And in the case of the master trust, even where you have a master trust where the financial services entity that's sponsoring it is either doing the admin, or in my case it isn't, or doing some of the investment work, that you are subject to external review. So as a trustee of a master trust, we have commissioned one consultant to come back and critique the product, and another consultant, external consultants, to come back and critique the investment strategy. So there is a creative tension between the contract world that the master trust, the providing entity has a contract with us as trustees, and we have a trust-based relationship with the client. So it's not something that was designed in heaven, but it's something that can work in the world.
Thank you very much.
Thank you, Alan. Charles Coates, trustee. Could I ask you about DC member engagement? It seems to me there's a risk that the trustees will do everything they can to run the DC scheme properly. They'll try and engage with members, but when they get to retirement, members will still be disappointed because they didn't engage early enough. Any suggestions on how we can address that risk?
What was the cause of the disappointment at the end?
Insufficient contributions early enough in life.
Yeah. And that's why I began with my first risk being that of sufficiency, and that's why we do need a basic state pension that provides that guarantee against absolute poverty. All we can do is try to deal with relative poverty. But if the individual has been on long life, low pay, intermittent pay, with contributions based on that pay, there's not an awful lot that we can do by pulling investment levers that will compensate for inadequate contributions. All that we can do is provide members with regular encouragement to do financial health checks, to see how strong their bank account is, to see whether they have the right form of rainy day savings, and to make them understand the limitations of their pension and to identify anything that they can do to boost that pension. But sadly, at the moment anyway, DC schemes rarely attract the same level of contributions that the DB world provided. It wasn't just that the employer, certainly in the UK, the employer underwrote the DB promise. The promise was set at quite a high level, and indeed it became set at such a high level that DB got priced out of an awful lot of the market, in that those inside DB benefited from the fortress mentality, but nobody else could get into it. So sadly, there's no easy answer other than to encourage folk to regularly check in with their financial affairs and see if they can be arranged to give them the best chance of, as I said before, enjoying retirement rather than simply enduring old age.
Thank you, Alan. I am going to end this session here. Listen, thanks and welcome back. The coffee break's always too short. Our next speaker is Will Price, who's the CEO of a firm called D3 Global. Will works on regulation, investment, risk, social policy, with a focus on pensions and retirement income. Previously, he's been with the World Bank, with the UK Treasury, and with the UK Pension Regulator. And he supports developed and developing country governments globally, as well as a number of international organisations, the IMF, World Bank, etc., etc. A first degree from Oxford and a master's in economics from University College London. So, Will, over to you.
Great. Right. Thanks very much, Brendan, and thank you for the invitation. It's a pleasure to be here. Unfortunately, a place we've come to quite a lot over the last few years, with some work also with the Pensions Authority. But today, I'm going to talk about global lessons. We recently did 2 days on global risks, emerging risks. So this is the kind of the 15-minute version. So apologies if I'm going to skirt over some obvious and big things. But the aim is to kind of give a flavour of some of the things which are happening that we see globally that may be useful here. And one of the general reflections we find for occupational pensions is you typically get both the best and the worst provision, the best risk management and the worst risk management when you go country after country. And it doesn't really matter whether it's a developed or a developing country. A well-run occupational pension scheme is a fantastic thing to see, and there'll be people in this audience, I'm sure, who are kind of all over it. Whereas the other times when there's problems that we'll talk about, they can have very severe risks. So, as well as not giving you the 2-day version, I'm not going to give you the sort of very detailed into all of the defined benefit, all of the sustainability side of things. But just to note, the US Society of Actuaries have a really good, it's just a massive spreadsheet with over 400 articles on risk management in DB schemes. So for people who are so inclined in the audience, there's obviously massive amounts out there. And one of the things, for the first point about the global and regional context, is really to amplify something that Tim said earlier, that this is not the Pensions Authority suddenly waking up and deciding to force risk management on the pension sector. It's already happened in many other sectors in Ireland. Obviously, already there's a very strong EU drive, but it's really getting more and more ubiquitous globally. And you see that, and it's sort of very beneficial for people who want to find examples, whether it is the work of the IMF or the World Bank or UN agencies, as well as the international organizations, so the International Association of Insurance Supervisors in the pension space, the OECD, and the International Organization of Pension Supervisors. And the good thing about it being so global is that there's material that is at a very wide range of capacity levels. So again, I'm sure in this audience there are people who would be at the forefront of the debate and would be, creating things on the leading edge. But there may well be people, and certainly in the wider trustee world, who do not feel as confident. And there's lots of material that has been developed for how to take the first steps. The second point I wanted to make before going on to some of the more detailed slides is risks and outcomes. One of the biggest things we see, biggest problems is, so someone gets risk, you're being told by the regulator you have to focus on risk. Huge amounts of work done, loads of Alan's doorstop example, but no one really asked the prior question, the risk to what? And regulators make this mistake when they talk about risk-based supervision and we're going to focus on the risks, and then they come up with lots of things people should be focusing on. In Ireland, the Pensions Authority talks about good member outcomes, and it's a pretty good place to start in terms of it's the risks to the outcomes. So one general message is, it's very easy to do an enormous amount of work and then realize actually you haven't really focused on the things which are most important to you, your scheme, the next few years, 5, 10, 20 years. So the risk to what may seem really obvious, but is a pretty important thing to focus on. So the next thing, again, is one of those slightly obvious messages, but when people start doing a lot of risk work, there's a tendency to come up with massive long lists, and there's a lot of things you can wake up worried about 3 in the morning. And so let me check I can do. Oh. So this is a set of risks from Sonar, which is something from Swiss Re that some people may be familiar with. And they're looking at the top risks, 2017, 2018, 2019. And the ones I've ringed there, you see the risk of inflation, the return of inflation, well, a couple of years early, but that was very profound. And actually sort of, I suppose a tiny bit in contrast to one of the earlier comments, it's underestimated infectious diseases was there as one of the major risks identified. This is predominantly an insurance company audience in 2017. Now, the question you ask yourself is, what did anybody do? And your best guess is probably nothing, because you sit there thinking, well, what can we do? And now we're obviously all much better aware, unfortunately, because of COVID, of the kinds of things that could happen. And one of the things then is the message of taking action. But it's also that the action you take on a particular risk may actually then pay dividends. So lots of people have probably already or would have done things in terms of disaster recovery, thinking about a cyber attack, fires in data centers and all the rest of it. The people who put more effort there, come COVID, were the ones who could more instantly go to a remote model. So they didn't predict COVID, but they were focusing on the preparation, the action for the kind of risks which stop you coming together in an office. So there can be multiple practical things that you can do whilst not necessarily exactly predicting the risk. And to kind of amplify that example, some of these are going to be complicated, require a lot of quantification, others not. But let's have a look at an example from New Zealand, which I'll take a little bit of time on. So what you're seeing here is the New Zealand Superannuation Fund. It's basically a big DB fund to fund the future pension liabilities in New Zealand. Set up, as you can see in the corner, 2003. Let me see if I can... set up in 2003. And the brown line is the investment return that they're meant to get. So it's treasury bills, short-term government bonds plus 2.7. And focus on the blue line now. So this is their asset allocation. This is their asset returns. And you see early years all going well above the target. And then you see the first red circle is obviously the global financial crisis. So this is essentially a trustee-governed fund. And life was obviously pretty uncomfortable in 2009. You've been going 6-7 years, and you have returned less than if we put all the money in treasury bills. So they were under a lot of pressure, but they managed to explain that this is a long-term strategy. These things will happen, and they had the credibility to carry on. But it was a profoundly important exercise for them because no one predicted it. And everyone said it's a kind of once-in-a-generation event. So then they started proactively embracing risk and doing the scenario analysis ahead. So the second red line is basically not reality. It's them saying, okay, so everyone tells us that was a once-in-a-generation financial crisis. What happens if it happens again only 10 years later? What would that do to our assets returns? And what does that tell us about actually whether we have the right approach? Because we believe in the long-term, risk-adjusted returns are better with equities, et cetera, et cetera. But actually, is that really true? And if we get multiple more regular crises, what happens? So they do the modeling, and as you can see, they dip down again, still actually a tiny bit below their long-term benchmark, but only a tiny bit below because of outperformance before then, and then they bounce up. Now, we didn't have another global financial crisis 10 years later. We obviously had COVID, and they weren't predicting COVID, but they were stress testing their strategy for just a massive, horrible shock. And the work that they did was then invaluable to understanding how to ride through that crisis. And so one of the key messages is really that a lot of the risk is not about exact prediction and patting yourself on the back because you were the one who predicted correctly what was going to happen next year or the year after. It's about going through a set of risks and then working out how you would react to them and embedding that in the work plan of the organization so that this is not just so much, charts of red, amber, green. It's things which are then into the work plan for the organization, going through and all the things that we heard earlier about making sure that all of these changes are enacted. Now, on the quantification front, what I've just shown is an example. Obviously, you need a reasonable amount of data to do that and capacity. Quantification is obviously important, but just the basics in pensions are too often overlooked around the world. And so what we're going to then talk about is the costs and the investment returns. And one of the problems that you see, and I'm sure, I don't know whether any of the trustees here would agree, that you get a huge amount of data when you're talking about the performance of a pension fund. Monthly reports, lots of monthly, 3-monthly annual returns on a huge range of assets, lots of conjunctural assessments and macroeconomics. When I was a trustee, it's kind of interesting, but most of the time it isn't telling you the profound things you need for risk, because it's short-term volatility, not the risk to your outcome, which is a good pension. So what we're seeing here is some work from a global benchmarking company on pension funds, and it's 1998 to 2016 just on this study. So this is longer term, not what happened in the last quarter. And you can see the list of different asset classes, so private equity at the top all the way down to US other fixed income. And the red bars are the total cost. So private equity is expensive. It costs around about 2.5% of assets under management on average. And then you look down those red bars, and some things, US large cap, number 4, cheapest chips, and you can do it for 10 basis points, 20 basis points, particularly if you use index funds. And then the big blue bars you're looking at is the net of fee return. And so over this period, of course, private equity has been the best net of fee performer. And so there's no high cost, low cost, good, bad. It's whether you're getting the returns from that particular asset class. And on the one hand, this is really obvious, but it's remarkable how few people look at this kind of data, how few, whether it's trustees, insurance companies, running pension funds, talking to members about this kind of longer term data. Because the really interesting thing, if you go down to the bottom, the second bottom, hedge funds, joint second as the most expensive and really horrible net of fee returns. And they have been systematically underperforming for well over a decade. There's a massive problem with hedge funds that most of the higher returns come when they're small, and then they balloon as they get inflows, and they cannot sustain the performance. But the standard way of showing returns is to do time-weighted, not asset-weighted. So this is, on one hand, it's a little bit technical, but it means that they get to show you they have fantastic average returns, even though when you put your money in, you're going to get very poor returns often, and obviously it's a broad asset class. So when people talk about quantification, it's not necessarily the world's most complicated stuff, more like the New Zealand superannuation side. It's the basics, but the basics over a time period where you can take a judgment and shift the risk allocation or the risk approach of a fund. One final part then, just because some things never change. So just looking at, this is from the Financial Stability Board, a bit of a global architecture that some people may have heard of, and it's talking about major risks that were again crystallized from the global financial crisis. And you see the top, this is core governance. What were the things which were repeatedly the causes of institutional failure during the global financial crisis? Leadership, decision-making, values, and behavioral norms. And you don't have to read the details, obviously the slides will come round, but this happens time and time again, and is why it's so good in Ireland that the Pensions Authority is focusing so much on the governance side of things. There's a great study from some Australian actuaries looking at failures of insurance companies over the last 250 years. And I think governance is the reason for the failure in probably 90% of the cases. So yes, there are other things, but governance every time is something to focus on. Now, I wanted to talk very briefly on climate and ESG environment, social and governance issues in terms of emerging risks. The Pensions Authority just released their survey of risks as seen by DB and DC funds in Ireland. And on the top 5 at least, it didn't have climate and ESG. I think that's probably a bit of an outlier. This is an area which is moving just incredibly rapidly. I mean, even 5 years ago, you wouldn't be having it on the agendas. EIOPA, the EU are obviously moving very, very rapidly and will do even more so. When you see the EIOPA recently given their advice to the European Commission about how you should go to IOP 3, which may be a sort of slightly daunting prospect since we're focusing on the implementation of IOP 2. But it's actually really useful to know because risk, more governance is a key part of the future, whatever happens under those changes. The climate side, ESG, is very important. Can be politicized, but you know the stat I always go back to, when BP had that platform failure in the Gulf of Mexico, that ended up costing BP $60 billion US. And if that's not enough to get it on your risk register as something you want to focus on, you're just not doing your fiduciary duty. So you can sort of get away from the US politics of whether you're one side or the other. It's just one of those things that cost an enormous amount of money if you get wrong, chews up companies, leads to bankruptcies. But going to the sort of state of the art, if you like, recently did some work for the IMF in Finland, which is a small country, quite large pension sector, and some who are doing some really interesting work. So this is from Ilmarinen. All of this stuff is published because they're beautifully Scandinavian and publish all of these things. So it's very useful. So for anyone, I know this is not top of mind for lots of people, but for some people who feel like they're more on top of other things, probably not a country people would think about, but there's loads of incredibly good data. And what they've done here, you'll see they're splitting the proportional share of the physical risks that exposes their corporate bond portfolio and their direct equity portfolio to risks of negative returns or negative outcomes. And you'll see, broken down at the bottom, wildfire, cold wave, heat wave, water stress. You go through the list. They have a global investment allocation, so not so many heat waves or hurricanes in Finland, but they have a massive forestry sector. So what you're invested in, or if you have a massive real estate sector, it's the combination of the concentration risk in your domestic market and then the markets in which you're invested globally. So there's a state of the art here. There's a whole bunch of other stuff which I have in the notes of the slides. Let me just sort of coming to the end, talk on cyber. This was in the top 5 risks that were in the Pensions Authority survey and is ubiquitous everywhere now, I think, and in a kind of scary way. So it can be one of those kind of rabbit in the headlights type of issues. There's something that everybody can do. Everyone can take a small amount of action on this, even small pension funds in terms of passwords and virtual private networks. But it is one where I think it's a different class of risk and that countries should be encouraging their regulators to work together to come up with a combined approach to cyber for any financial institution. And that is happening to a certain extent. But it's definitely one where there should be more and more pressure at an EU level, because with the best will in the world, you read outsourcing guidance in any country, you should check with your outsource provider about their quality, maybe do an on-site visit, talk about their risk controls and all the rest of it. You know, I guess if most people here pitch up to Amazon, I don't suppose you'll get past reception. The same thing about the massive providers of cloud services. Those providers of cloud services are very limited single point of failure, or maybe 2 or 3 points of failure. With the best will in the world, it's not really something that an individual pension fund, even of scale, can do. So there are some of these risks where it would be really important to make sure that the regulators are getting together, but also that you're using your European clout. Now, just coming to the end, last couple of slides. So the salience of a particular risk will depend on the regulator. So we heard that earlier. And you may come up with a list of the top 10, and the question is, well, I can only do 5. Which 5 should I do? There is a kind of, feedback loop, which is why these sessions are so important, to which ones you're going to do in Ireland. And that will obviously depend partly on what the regulator is saying. So governance is obviously a key focus, which is a good thing. The example I'm going to use actually is from Australia, where they had the data for decades on costs and returns, investment returns. There was systematic underperformance for decades of certain pension funds, but the regulator didn't really do anything about it. And then there was a very challenging set of reports from government agencies and external commissions. And regulator now has a very proactive approach. And what it does simply, it uploads the data quarterly on costs and returns. On the left-hand side here, you've got, these are just pension funds. These are the returns that they've got, and then they have a simple benchmark. I mean, not so simple benchmark actually, but simple to construct quarterly. And then they do a risk rating, and if you are clearly performing well below your peers, you have to explain why. If that's persistent, you have to have the reform plan, and if it's particularly persistent, they shut your fund to new members, and ultimately you have to withdraw the fund. And so these are for obviously more private providers in that space to retail members. This has already saved well over $500 million in fees with a positive impact on net returns because, as I said earlier, high fees can be very important and they can be worth paying, but often what you have is just legacy products, old high fees, a drag on returns. They're not buying you anything, they're just buying you lower net of fee returns. And the risk is borne by the members who typically don't switch. And so this is one where everyone in Australia is spending a lot more time on this than they would have done otherwise because of the feedback loop with the regulator. So let me just conclude with the key messages. So risk-based, ubiquitous almost globally, particularly in the EU, only makes sense with the clarity on the objectives. There's too much focus on the exact prediction rather than actual practical preparation. And every scheme can do something useful, just you will be at different ends of the spectrum depending on whether you're large and more sophisticated, depending on the quality of advisors. Benchmarking is critical and actually can be pretty simple because cost and investment returns, the trick is getting hold of the data, not that it's complicated. Some risks never change, government's always central. Others, like climate, environment, social governance, and cyber, are changing very rapidly and in a pretty scary way. And the regulator, the focus of the regulator will increase the salience of particular risks, but will also be a very useful way of having a joint focus in a country so that you can get your combined weight to tackle some risks which are common across schemes. Thanks very much.
Thanks very much, Will. Anybody got any questions? Will, can I get my question in? And you touched on this already, though, to some extent. There are lots of resources out there. One could lose one's life in going through all of these. How do trustees stop being overwhelmed?
Yeah, I think for me, by working back from the kind of long-term purpose, the outcome you're trying to get, and then thinking, does this matter? And so to take that investment return example, the amount, if you kind of weighed the amount of time and effort and paper that people look at for quarterly returns, and then you compared that to the amount of time they work out on long-term, the long-term strategy they'll have, the provider, the contractual relationships with the provider, benchmarking relative to their peers to see whether they're getting a good deal or a bad deal. For me, all of that kind of benchmarking, contractual stuff is probably worth loads more, or is worth loads more than that monthly, quarterly return. And actually, it sort of ends up in some ways easier because you don't have to be a world's best investment expert. You have to be the expert at asking the question, is this value for money? What are you getting? What are other people getting? So those kind of things, I think, can help simplify it. And then, as I say, it's kind of linking it, the reason, or the point everyone's making about risk being a new way of, or the way of doing business, it's just part of the way you run your scheme. So there isn't sort of, these are my 3 priorities in my strategy, and I've got to do the risk. They're one and the same thing. And so whatever you come up with as the priorities for action is then actually just doing them. And you won't get through, if you can only do 3, but at least do something rather than, I've worked in organizations where there's a great risk register, it's very long, everyone discusses it quarterly, and then you go back and do your day job. And it's completely pointless. And so making sure that it's better to integrate, doing less which is integrated than seemingly more, which doesn't kind of touch the sides.
is there, trustees aren't intended to be subject matter experts, but life is really, really complicated. And even if we look at the high level risks, as you said, administration risk, cybersecurity, investment risk, I think there's, in my head, communication risk, value for money, and we expect, the Pensions Authority expect, and I'm not apologising for this, obviously, we expect trustees to manage all of these complexities, and to some extent, making risk decisions is about identifying the strategic decisions you need to make about really, really complicated issues. Identifying what you can do, identifying what you ought to do, and coming to a decision, and then obviously implementing it. Have you seen this sort of complexity as a problem?
It's definitely a challenge, particularly in lots of countries where I suppose the average amount of capacity or expertise is lower. So Ireland has a massive range, like the UK has a massive range, from some of the best run schemes to some which are the smallest. But you go to countries where there's, you don't have the top end of the range so much. Yeah, I mean, I think if people don't have the ability to do a huge amount of risk assessment, well, there's one, it's kind of working out the scenarios and the kind of what ifs and spending more time on that than becoming the subject matter expert. So what if I don't identify a risk which could kill the scheme? Well, that's pretty bad. And it may well be that the right answer is not, I need to get better at risk management. The right answer is, I need to stop running a scheme. And so that's obviously your consolidation agenda. And there should be lots of, I think, pretty clear and tough conversations being held, like, unless you can see a good path to be able to do this well, you probably shouldn't be running an independent pension scheme. And that may be the best risk management decision that group ever take, rather than having lots of people fighting heroically to achieve a level they're never going to achieve. And then with other people, there's a realistic path that they can take in terms of access to advice, different trustees, training, all of those good things, where there's a realistic path. And as they're getting better, you can focus on the practical things. So, it sounds stupid, but one organization I worked for, the chief executive was worried about losing data. And it was a government organization, a time when the UK Tax Authority had sent two discs with 25 million records of people through the post and lost them. And that is obviously not good risk management. And so he said, I don't want anyone being able to put a USB in a computer in my organization and download data. Really annoying, by the way, if you're working in that organization, but at least you can see that was a simple, practical thing where you closed down a catastrophic risk. A little bit annoying, but actually you can carry on business. So you don't have to be a cyber expert to start narrowing down the scope of the risks to which you're exposed. And then if you can see that, and then I'm going to have a cyber audit, and then we're going to do all the other things. Or I'm going to get an external benchmarking firm to look at my investment performance compared to my peers. And you have a little bit of this in the data scene in Ireland, but much less than other countries in terms of being able to know how you're doing relative to peers. I'm sure people got private data. That's actually not very complicated. It's like, oh, okay, well, it turns out we're at the bottom of the list and have been for 10 years. That's not a very complicated decision to engage in. Knowing exactly whether you're going to do, more private equity in a liquid in the current global conjuncture, that is more, but that's why you pay an asset manager. But whether the asset manager is any good is the long-term comparator against their peers. And that's why I'd simplify what you're looking at by looking more long-term.
Thank you. Okay.
They're saving all my questions for you.
Right. I'm going to move on to our final speaker, Grace Guy, Head of Supervision Enforcement at the Pensions Authority, familiar to many of you. Grace joined the authority in 2010, which was longer ago than I thought, Grace. She joined us as legal advisor, subsequently became to run the authority's legal unit. Grace is a qualified solicitor and she's advised us on all aspects of our remit. And Grace represents and has represented the Pensions Authority at various national and international fora. So rather than talk more, over to you, Grace.
Good morning, everybody. So we've had some really interesting speakers this morning, and now we're at the regulatory part. So what I want to do in this session is set out the Pensions Authority's views and expectations on risk. And I want to do that with as little risk speak as possible. The areas that I'm going to cover are the background to this. So why are we here? Why are we talking about this? I'm going to talk about what the Pensions Act says. I'm going to talk about the own risk assessment. Tim spoke about it in an insurance context. Importantly, I'm going to talk about roles and responsibilities. So who are the moving parties here? And what are our expectations of them, and what do they need to know? And then I'm going to finish up with some key messages from the Pensions Authority. Okay, so as we all know, Irish pensions is going through a period of unprecedented change. And for a lot of us, the catalyst for that was the IR2 directive. Came out in 2016, it was transposed in Ireland in 2021. But a lot of the thinking in IR2 was around, it was following the financial crash, and it was catching pensions up with other financial services providers. And one of the things it wanted to do was to introduce a modern risk-based pension scheme governance approach. And that's actually set out in Recital 6. So if we come back then to Ireland, as we know, and we've spoken about it already here this morning, we have this really unusual position in Europe where we have, I think the IOPA phrase they say is we have 99% of Europe's pension schemes. The numbers vary depending how you slice and dice them. But the figure we use often is over 150,000 schemes. The majority of these are small one-members, small one-member arrangements, and many of those are inactive. But you can just see from that number that effective supervision, making sure schemes are run properly, governance, and we're going to talk about how governance and risk interact, and critically for members, value for money, that is incredibly challenging to deliver with that amount of schemes. And so IRP2 came in and introduced higher thresholds, higher standards for trustees. And as we have seen, many Irish schemes have been unable to meet these new requirements. And so what we're seeing now, what's happening out there, is we have this, the catchphrase is consolidation. So this is mentioned in the government roadmap. It's a strategic objective of the Pensions Authority. But what's happening is that there is this mass migration of Irish schemes. So there's significant movement underway by schemes, and they're moving into master trusts, and they're moving into PRSAs. And okay, so we know why they're doing that. We know that the governance standards are higher. We know it's going to cost more. And so there's an added burden there. And many schemes have made the decision to move. But the other reason behind that is, and again, there's a lot of obvious points here, that there is inherent uncertainty in providing for retirement savings. So as we know in pension schemes, and Alan spoke to this, we're not thinking about a year, 2 years. We're thinking about 10, 20, 30, 40 years. So risk is everywhere in pensions, and there's no way around that. So the pension schemes that are remaining at the authority, it is essential to us that these schemes embed fit-for-purpose risk management practices. In our view, comprehensive risk management is very new for a lot of Irish schemes. Certainly, for maybe some larger defined benefit schemes, they would have established risk management practices. But having a risk management key function holder, for example, that's new for everybody. In the work that the supervision and enforcement do, we're engaging with schemes all the time. And so we're asking questions about risk. How are you approaching risk? And in our view, people are trying to grapple with it and get their heads around what is very complicated. And again, part of the whole reason of today is to raise awareness around this. But essentially, to be really clear that we expect trustees to give sufficient time and attention to how they approach risk management within their schemes. And that's on the trustees, okay? So again, in terms of responsibility and accountability, the IRB 2 directive, again, very squarely has put the responsibility for good member outcomes, for ensuring that the beneficiaries and members, the people that count, the people why we're all here for, that they have somebody in the driving seat that is in charge and that is taking their responsibilities seriously. So risk management, in our view, it cannot be mechanistic. There's no checklist, there's no tick box formula. Again, to quote Alan Pickering, we want trustees to think about this. We want them to engage with the individual factors of their own schemes. So in terms of the formalities around risk management, and many of you will be aware of these, and I'm not going to go through them in detail, I'm just going to pick out a couple of them. Probably the key point is that the Pensions Act has a whole section on risk, and it provides a template of a risk management framework, okay? What I want to touch on is risk and the connection with risk and governance. So Will picked up on governance there, and it's something that we're very focused on in the authority for good reason, because when things go wrong, the research, the data shows that more often than not, it's due to governance failures. So if schemes have a fit-for-purpose risk management function, and I'm going to talk about the own risk assessment in a moment, which is a very important document, that needs to be interwoven with the effective system of governance. So the two should work together. They shouldn't be alien. They should talk to each other. Risk and remuneration is something to mention as well. So the directive, of course, zones in on how people are paid and ensuring excessive risk-taking is avoided. And that's set out in the section around remuneration policy. And then there's a section generally on the risk management function, and critically, the function has to support an ongoing risk management system. And then we have the own risk assessment, which I'm going to talk about a little bit later. But probably the key takeaways from the Pensions Act is that the Pensions Act envisages an ongoing and dynamic approach to risk. So it's not just a series of tasks. You know, you've got your risk register, have you done your aura, have you got your heat map, all the millions of documents around. It's a way of thinking that permeates through all aspects of the scheme. And the trustees need to make sure that the risk management function is well integrated into the decision-making processes of the scheme. So again, this is about the left hand and the right hand talking to each other. We want to avoid siloed areas within schemes and in terms of how schemes are managed. All of this is about things being out in the open and there being ongoing dialogue and communication. And of course, we have this new function the IRB2 directive introduced 3 new functions, and one of those is a risk management key function holder, which is really important for supporting the delivery of the risk management function. But again, to emphasize, trustees are responsible. Okay, so I'm going to talk a little bit about the own risk assessment, the ORA, and just to say that we are publishing some guidance later on today. It's going up on our website, and that has a lot of detail in it around our expectations. So I want to sort of just pick out the key takeaways. So as many of you will know, first of all, the ORA is it's a periodic, structured, thorough assessment by trustees of the risks faced by the scheme. So it's where the trustees look at their scheme, and we've just heard about all the complexities behind this, and they say, what risks are we facing? What's going on? Critically, it's not just about doing the examination, it's about taking action. The trustees must draw conclusions from the findings of the ORA, and then they have to decide what to do. And the ORA, again, needs to be, there can't be a template ORA. It must be sufficiently flexible to work with the individual risk scheme profile, whether it's defined benefit, defined contribution, master trust, depending on its size. There may be loads of other different factors. Again, we're repeating, we don't want this to be a mechanistic process. We want it to be comprehensive, so you're looking at everything. Where possible, and it's not always possible, we want it to be data-driven. Critically, it has to be objective. So it can't just be a rationalization of the current state of play. And then you have to be able to implement it. And that's what we're going to be looking at. So there's a huge amount behind that. And I think that's a useful summary. So again, setting the scene. The ORA, it's a specific task and activity within the wider risk management function. It should happen at a minimum every 3 years, or if something significant happens, then it should be revisited. It must identify the risks, it must measure them, and it must evaluate them. And then, as I said, the trustees have to take action. What are they going to do? How are they going to deal with the risks in front of them? So there's more information in our ORA guidance, and there is actually a checklist at the back of the ORA guidance. It's just... So there is a checklist of practical things. Okay, so we like checklists for practical things. That makes sense. But we don't want a checklist when you need to think about something. And we don't expect that our guidance should be your starting point. We expect you should have been thinking about this already, and that you might, do your thinking and then refer to our guidance and see how you measure up. A reminder then that the first ORAs are due in April 2024. Many of you here will have already completed ORAs. We're working with Master Trusts, many who will have completed ORAs, but the first official deadline is April 2024. So just a reminder on that. Okay, so moving on then to looking at the players here. We have our trustees, and also we have this new function, new people involved, the risk key function holder. So there's a lot of repetition here, as you can see, and that is often the way for regulators. So the quality and the integrity of the risk management function as a whole, so as I said, that's everything, and it includes things within it, like the ORA. That is unambiguously the responsibility of the trustees. The trustees can, and of course probably should, engage professional advice to support them with the risk management function, but they cannot outsource their responsibility. The buck stops with the trustees. In addition, and this links to governance and the wider culture, the trustees should ensure that the risk management key function holder can do their job so that they can carry out the function in an objective, fair, and independent manner. And then also, it's also for the trustees to make sure that they hire the right people, that they're satisfied that the risk management key function holder has the requisite knowledge and experience to perform the function. Now, of course, for key function holders, I'm sure they will want to be satisfied of that themselves, but it is for the trustees to make that call when they are hiring someone and when they're renewing a contract to check that qualifications, experience, etc., are up to date. So, as I said, the risk management key function holder, they themselves must satisfy the knowledge and experience requirements. The risk management key function holder must support the trustees, and they have to be objective and independent. And that can be difficult when somebody's paying the bill for you. In our view, the risk management key function holder has to be able to challenge the trustees if necessary in the area of risk management, if they have doubts around how decisions have been approached, or if they have doubts around processes. And the risk management key function holders also need to be mindful of their relevant whistleblowing obligations under the Pensions Act. So if they see something untoward, they need to report that. So in conclusion, the authority's view, I think, probably can be summarised in this slide. We need to have a structured approach to risk management for Irish pension schemes. That's just unnecessary considering the uncertainty that exists within providing for retirement benefits, for trying to plan long-term savings into 30, 40, 50 years. We don't want the approach to be mechanistic. And if there's one thing we want you to take away from today, it is we want you to think about this in terms of your own scheme. There is no magic answer. We see the ORA, the own risk assessment, as one of the trustees' most important responsibilities. And we think if that's done right, a lot of other things should fall into place, and that should work well within the overall governance structure of the scheme. We expect the ORA to be comprehensive, data-driven. Critically, it has to be objective, and you have to implement it. The Pensions Authority is going to be focusing on risk and risk culture. We're about to roll out our 2024 supervisory review programme, and that's another part of the directive which puts obligations on us as a regulator in terms of how we supervise. We also have to be forward-looking and risk-based. So the own risk assessment, that's where the trustees, they go, they assess their risk, and they decide what to do. When we come in and do an SRP, we review that process. We say, was it fit for purpose? And that's going to be starting in 2024. Bringing it back to basics, good member outcomes are the desired results of effective risk management. All schemes need to upskill and embed effective risk management. This conference is the start of that. We're going to publish the guidance later. Hopefully that will be helpful. We know there's a bit to go on this, and we're keeping a close eye, and we are interested in feedback. One thing we always try to do is be practical and connect with what's going on. on the ground. But ultimately, risk management is about ensuring that members and beneficiaries receive the benefits that they are entitled to. And again, that responsibility lies squarely with the trustees. And so when we are interacting with schemes, it's the trustees we're talking to. So you can have advisors in the room, that's fine, but we want to hear from the trustees. So thank you very much. I hope that was helpful. So I think I'm going to take my own questions, which is a bit unnerving. It's kind of hard to see up here.
Thanks very much, Grace. Charles Coates, trustee. Could you tell us a bit more about this SRP programme then, and where you're going to be focusing, what schemes are going to come through? It seems to me that the policy objective of consolidation has moved us from a position where the consequences of risk failure are individually trivial to one where the consequences are actually systemic. So I presume master trusts are going to get a lot of focus, but beyond those, where are you going to go?
Yeah. So just to back up, I suppose, on the SRP, so again, SRP stands for Supervisory Review Process. It's an obligation on the regulator, so it's about us ensuring that we're looking at schemes properly. And the key thing that we're looking at is, how do trustees work with risk? And so we've been doing a lot of work on it, and as you mentioned, Charles, because of what's happening with the landscape, the immediate priority will be to focus on master trusts and also larger defined benefit and defined contribution schemes. We're obviously watching the pace of consolidation and seeing what's happening there. And as time goes on, the idea would be to work through all remaining schemes. And that would be our objective, because for us, essentially, the SRP it's the proper look under the bonnet. And because of what we've set out, because there's so many schemes, and also because of the authority, we have limited resources, risk-based regulation, you have to decide where you're going to focus on. And as the numbers come down and we're left with a smaller number of large schemes, that means we will actually be able to go in and really, as I say, look under the bonnet and specifically focus on trustees' approach to risk, because there's so much there. So we'll be issuing an alert on that in November, and then that programme will kick off in 2024, and we will have more official communication on that throughout next year.
Hi Grace, how are you? Aaron Kilboy is my name, I'm a consultant. I'm just curious, have you read many ORAs yet? And if you have, what have you thought of them, the overall standard?
So we haven't been officially, other than master trusts, we haven't officially been looking for the ORAs, and that's partly because the deadline isn't until April 2024. And on the master trust side, I think touching on Tim's earlier comments, what we're seeing is a first iteration, and there's some good stuff there, but I think people are figuring things out. And obviously, because the master trust sector is in it's in a period of, there's a lot of movement going on. There's quite rapid growth at the moment. So, there's particular circumstances there. So by and large, what we've seen is fine. I think hopefully post 2024, when we roll out the SRP, when we really get to have a deep dive on these, I would hope then we'd be in a position to come back with a bit more detail around, this needs to be improved, or some further thoughts on this and that. Again, though, just to reiterate, we don't want to be the school teacher on it. You didn't do this, tick, part of it, I think, probably involves a conversation, with trustees, and that's more particularly what forward-looking risk-based supervision is, particularly if there's a more manageable number of schemes, it is about the regulator being able to have a dialogue with the trustees. I mean, we don't know. Trustees are best placed. So we do want to understand where people are coming from. And we want to develop our own knowledge on that as well.
I think, and as Grace said repeatedly, and all of us in the Pension Authority have said many times, we're trying to avoid templates, we're trying to avoid box ticking, but obviously the other side of that coin is that there's going to be divergence among the ORAs that different schemes produce. Divergence isn't per se a bad thing. There'll be divergence of subject, there'll be divergence of approach, but there will also be, let's be frank, divergence of quality. I think the role of the risk key function holder is really, really important here. And although trustees are central to everything we, the Pensions Authority, do, the outside perspective and the outside expertise the risk key function holder can bring is going to make this work a lot better. And we don't want to diverge on the same aura, but we want to converge, quite different, on the same level of quality. And the key function holder is, I think, vital to that process. You know, if schemes are only doing an own risk assessment every 3 years, we really don't want it to take 3 iterations of that process before we get to where we want to. You know, there's only so much time here.
And then we're finished and we can have lunch.
Thanks very much, Grace, and thanks again to all of you for being here. I am not going to try and summarise what we've heard here this morning, but what I say will be familiar. Our fundamental objective in the Pension Authority is for trustees to take responsibility for their risk management. Not to take responsibility for the task of risk management, but to take responsibility for the fundamental approach, the fundamental thinking to internalise, I suppose, risk management. Obviously, there is on the one hand there is the provisions of the Pensions Act. There's even some Pension Authority checklists, and then on the other hand is the specifics of your scheme. And trustees will live in that gap. We will define a certain level of activities, but the trustee's job is to translate those, abstract requirements into a real, useful, relevant process that will improve the outcomes for their schemes. And as Grace referred to culture, and I think that's enormously important. Yeah, it's a touchy-feely term, but the attitude, the culture, the approach of trustees is really what we're trying to do here. And as Will said, there must be a focus on outcome. And that's the purpose of this. It's not to do work, it's not to satisfy a 3-yearly requirement. It is about improving, as far as possible, the benefits to members. And I think it's really, really important, and again, I'm reflecting something that Grace has just said, that we, the Pensions Authority, and you, the trustees, we want the same thing. We don't want to catch people out. It's not our job, it's not our ambition to discover non-compliant orders. It's not our, if we find non-compliance, we will take an appropriate approach. But what we want to do is, as Grace said, to have conversations. The ideal is that we go to meet the trustees of the scheme and the trustees bring out their aura and initiate the conversation with us. Here's what we did, here's where we did it. Now, this is an issue that we've struggled with, and we welcome a dialogue between ourselves and yourselves to talk about this, and maybe the Pensions Authority could bring a welcome perspective. And equally from our point of view, oh, that's how you did your order. That's interesting. We haven't seen that approach before. Let's talk about it. That is our ideal. And that, I think, is the trustees' ideal, because it's that conversation, we need to make that conversation more and more natural, because we're never going to be done. Risk management, risk assessment is something we're going to be stuck with for the rest of the lives of these schemes. It'll never be perfect, it'll never be capable, it'll never run out of areas to improve, but we need to get to a situation where it's just part of our lives and it's part of we learn from each other. So our objective here today has been, well, not quite to put the fear of God in you, but just to, although I like to think there's a little of that, but I suppose if you haven't already done so, and I suppose the fact you're here means you recognise the importance of risk. I hope our 4 speakers have given you food for thought. They've certainly given me food for thought. A lot to take away. There is an awful lot of information, resources, and examples out there. And I would encourage trustees to learn as much as possible from that. But all in all, I just like to re-emphasise, firstly, the importance, the centrality of the ORA. Secondly, as Grace said, our own guidelines this afternoon. And thirdly, the fact that if you haven't already done so, April 2024 is a really important date for you. And we look forward to engaging with you on or after that date to develop these ORAs and to develop risk management better. So thanks to all our 4 speakers. Really, really appreciate the time and effort you've given us. And thanks to all of you for being here.